Right now, a massive $3 trillion lending market is starting to raise concerns, especially inside retirement accounts like 401ks and pension funds. It's called private credit. And over the past decade, it has grown incredibly fast. So let's break this down. What is private credit? Why are experts starting to worry? And how could this impact everyday investors? The hidden market behind the warnings. Private credit is actually pretty simple. It's lending that happens outside traditional banks. Instead of borrowing from a bank, companies get loans from investment funds, private equity firms, large asset managers. This market really took off after the 2008 financial crisis. Back then, stricter regulations made banks more cautious about lending. So, a lot of that lending activity moved into private markets. Since then, private credit has exploded, now estimated between $1.8 trillion and $3 trillion globally. Supporters say it helps businesses access funding. But critics say the speed of growth may be hiding risks we don't fully see yet. Why experts are starting to worry? One major concern is the companies taking these loans. Recent research suggests that over 40% of private credit borrowers have negative cash flow. That means they're not generating enough money to cover their expenses. Instead, many are relying on continued borrowing, flexible loan terms. Now, that doesn't mean they'll all fail. But it does mean a large part of this market depends on companies improving over time. If they don't, lenders could start taking losses. The valuation problem. There's another issue, and it's less obvious. Unlike stocks or bonds, private credit doesn't trade daily on open markets. So prices aren't constantly updated. Instead, many funds estimate values internally, update them periodically. This can make investments look very stable, even when underlying risks are building. But if defaults start happening, those values can adjust very quickly. Some economists say this delayed pricing makes risks harder to spot early, which is why comparisons to past financial bubbles are starting to come up. Why Wall Street is raising red flags. Several major financial leaders are now speaking up. Lloyd Blankfein said the current environment reminds him of the period before the 2008 crash. Not an immediate crisis, but possibly growing risk. Dimon also warned about pressure building in credit markets. After a failed private credit deal, he used a famous line: "When you see one cockroach, there are probably more." Meaning, one failure can reveal deeper hidden problems. Economist Mohamed El-Erian has also warned that stress in this market could expose valuation gaps and liquidity issues. None of this guarantees a crisis. But it explains why people are paying closer attention. Why retirement accounts are now involved. This is where things get more personal. For years, private credit was mostly limited to pension funds and endowments, large institutions, but that's starting to change. New policies are opening the door for 401ks to include alternative investments like private credit. Some funds may allocate 5% to 20% into these assets. Supporters say this could boost returns, improve diversification, but critics point out a key risk: these investments are harder to sell during market stress. So if markets turn unstable, they may take longer to adjust in value, be difficult to exit quickly. For younger investors, that might not be a big issue. But for those near retirement, liquidity matters a lot more. What this means going forward. Right now, most economists are not predicting an immediate crisis. The financial system today is generally stronger than it was before 2008. But history shows something important: risks don't always appear where we expect them. They build quietly, in new parts of the system, until small cracks start to show. And that's exactly why private credit is now getting so much attention. The big question: so here's what investors are starting to ask. Is this just a normal phase in a fast-growing market? Or is this the early stage of a financial risk building beneath the surface? And if something does go wrong, how much of that risk could reach everyday retirement accounts like a 401k?